And so 2010 was the year the inversion took place where central banks became net buyers. And they've been net buyers ever since. And the buying is accelerating. Well, gold's going to go higher because the dollar is going to go lower for measured by weight of gold. I should be clear about that. And so you say, okay, that's a statement. What are the facts to back that up? What are the trends? What's the data behind that? The biggest single factor, and it's bigger. I'll talk about BRICS in a minute, but it's bigger than BRICS. Is from 1970 until 2010. Central banks were net sellers of gold, starting with the United States. Everyone, August 15th, 1971, Richard Nixon shut the gold window, stopped the convertibility of U.S. dollars by foreign trading partners into gold. By the way, they said, and I've spoken to two of the participants, two of the people who were at Camp David that weekend when Nixon made that decision, Kenneth Dam and Paul Volcker. Paul passed away, but just to confirm my understanding, I said that was meant to be temporary, right? Because Nixon said temporary. You can find his speech. And they said, yes, absolutely. We wanted a timeout. We were going to have another monetary conference, devalue the dollar against gold, and then go back to the gold standard. That was the plan. They called the timeout. They did devalue the dollar against gold from $35 an ounce to $42 an ounce. They did have the monetary conference at the Smithsonian in December 1971. But the only problem is they never went back to the gold standard. But that was the plan. But throughout the rest of the 1970s, the U.S. continued to dump gold on the market. Kissinger was involved in this to kind of defend the dollar. But finally, in 1980, the U.S. stopped. We haven't sold any material amount of gold since 1980. The reasons for that we don't have time for. There's a whole mystery going back to when Roosevelt took the gold from the Federal Reserve and gave it to the Treasury. And the Treasury, under the Fifth Amendment of the U.S. Constitution, you can't steal or take property without giving just compensation. Our Constitution requires that. So what was the compensation that the Treasury gave to the Fed, which is privately owned, for the gold that they took? The answer was it was a gold certificate, which is still on the balance sheet. But if you do the math, it's not difficult. It's on the books at $42 an ounce. If you revalue to, just the market, it's around $26.50 today. And multiply it and figure out, well, how many ounces do you need to back up that certificate? The answer is almost exactly what the U.S. holds, which is 8,133 metric tons. Just convert that to ounces. So query whether the Treasury is in effect legally prohibited from selling any more gold because it has to keep that amount to back up the certificate. That's a monetary mystery, but kind of just circle that a little bit. So what did we do? Well, in the late 90s, we suckered the British into selling half their gold. They did at $250 an ounce, by the way. That was Gordon Brown was the Chancellor of the Exchequer. It's known as Brown's bottom. But he did manage to sell the gold at the absolute, that's like a 60-year bottom. So nice job, Gordon Brown. Then in the early 2000s, we put pressure on the Swiss, and the Swiss sold 1,000 metric tons between 2000 and 2009. Finally, the Swiss rose up in a peaceful revolt and had a referendum, and the Swiss National Bank said, no mas, no mas, we're not selling any more gold, and they haven't. And we got the IMF to sell, I think, 400 tons in 2010. That's it. No more suckers. And so 2010 was the year the inversion took place where central banks became net buyers. And they've been net buyers ever since. And the buying is accelerating. Russia has quadrupled its gold reserves from 600, this is 15 years. Russia has gone from 600 tons to 3,000 tons. China, about the same, 600 tons to 3,000 tons that we know of. Could be much more. But also Iran, Turkey, Philippines, Kazakhstan, Mexico, Vietnam, if you go down to India, even Japan somehow pulled 300 tons, probably in the back room, but we've restated their gold reserves from 600 tons to 900 tons. This is all by weight, by the way. I'm not talking about dollar valuations. So what that does, if you're an investor, it's my favorite kind of trade. It's called an asymmetric trade. You have a kind of floor, no guarantee. But if central banks are buyers and continual buyers, and they don't try to gobble up all the gold in the world at once, the market's very liquid, but not that liquid. Russia is a good example. 10 tons a month, 20 tons a month. It's a little engine that could, but you do that for 15 years and you're going to get thousands of tons. But they kind of put a floor under things, which means you can buy. It doesn't go up the next day, but if the trend is up and there's a floor that keeps it from going down because the central banks come in and maintain the floor, that's a beautiful thing. And so that's one trend. Now the BRICS have accelerated that because they are in the process of they're doing a couple of things at once. They're coming up with their own currency, but very slowly. We might not see that for 10 years. And people say, well, they can't do it and all that. Well, I remind them that the Maastricht Treaty was signed in 1992, and the euro was not available until 2000. That took 8 years to figure out. I know Alberto Giovannini is one of the scholars who worked on that. And so, look, if it took the Europeans 8 years, I imagine it would take the BRICS, which is a little bit more of a polyglot kind of organization, just as long. By the way, the biggest issue in Europe and the euro was the conversion rates. I mean, you got Italian lira, French francs, German Deutschmarks. So, how would you value them all relative to each other? The purpose of saying, okay, lock it in. Here's the euro. That took a while because the Italians wanted a little better valuation. The point being, that will take a while. But what is not taking a while, what is happening in real time, and a lot more progress at the BRICS Leaders Summit in Kazan, Russian Federation, that just took place a little over a month ago, is they've come up with their own payment system, and they're going to use their own currencies, transacting in a closed circuit, meaning secure payment system. So Russia will ship energy to China and get paid in yuan, and yuan will China will ship manufactured goods to Brazil and get paid in rice. And if you want to buy, if India wants to buy Embraer aircraft, et cetera, they'll pay in rupees. So there'll be all these do tos and do froms. The way you handle it in the real world is you keep a ledger. Now the central bank comes in and pays all the sellers in local currency, and then they absorb the due from the trading partner on a central bank ledger. That's what this it's called BRICS Clear. That's what this system will maintain. But you have to settle up every now and then. But the thing is, you can settle up on a net basis, not a gross basis, which means there's far less money moving back and forth because you're going to get credits for the things you sold to pay for the things you bought. You don't have to settle up in real time. You can, but you can settle up quarterly, let's say. So a quarterly net settlement is not that onerous. And how can you do that? Gold. In other words, if in the absence of your own currency, your own BRICS currency, which is some years away, you can use gold as the coin of the realm, so to speak, and you can move it. You just put it on a plane and fly it around, but you don't have to. Again, as long as you have a ledger, I'll say, well, I'll clear all my debts to you in gold by weight. That would, and you can measure it in yuan or rubles or anything else. And it was interesting to note that along with this BRICS Clear system I just described, they're coming up with a commodities exchange. Again, it's all non-dollar denominated. There are no dollars in this whole system, but gold plays a very significant role because it is the only common currency of the now at the moment 9 members, but probably on its way to 20. They green-lighted, I believe, 17 new members. It's kind of like joining a club. You don't become a member overnight. You got to do the application, go for the interview and all that stuff. But they green-lighted a bunch of applicants, and they'll be adding members. So that monetary and trading union is going to expand. But the only common currency is gold. So again, whether you're just any old central bank that wants a reserve that's not a U.S. Treasury because we're in the habit of stealing them, or you want something that you can use for net settlement with your trading partners in the absence of a common currency and dollars. Gold is very much in demand. To answer the first question, I would say they already have their common currency. It's called gold, that which we just went through. So they don't need somebody actually printed up a BRICS, I don't know what they call it. It wasn't a dollar, but, one brick or whatever, like a note, and they gave it to Vladimir Putin because he was the president of the conference. They've already solved that problem with gold, number one. So it's already happened, which is why you can be very bullish on gold. Number two, the currency will come along in due course. As I say, the euro took 10 years. Let's give the BRICS, give them a break, give them 6 or 7 years to figure all this out. But the secure payment system and the ledger, and it's a digital ledger, by the way. It's not a cryptocurrency. It's not a central bank digital currency yet, but it is an encrypted digital ledger. That's what they're building, and that's what they're unveiling. So I would say I wouldn't sit around waiting 10 years for the BRICS currency. I would say they're doing it now. And if you said, what's the common denominator? It's gold. I think you just have to understand the monetary system. If it's not gold, what is it? And as far as is there an aha moment, or what some economists call a Minsky moment, when, all of a sudden there's a, repudiation of the dollar, everyone's dumping U.S. Treasury securities. You don't need that. What happened, I think a better case study is sterling. So in 1913, sterling was the undisputed global reserve currency. Gold was actually money at the time. You might have some Bank of England notes. That's convenient, but you could just as easily carry a purse full of sovereigns, a quarter ounce British gold coins. And no one doubted that. But beginning with World War I, you could almost pin or pick the beginning of the demise of sterling. It was November 1914. Of course, the war started in end of July, early days of August 1914. I don't think so, and I'll tell you why. It's a very powerful weapon used at the right target. Now, people are kind of blunt, just like black or white, yes or no, etc. I happen to be an expert on sanctions, and a lot of the work I did for the intelligence community, for the CIA, involved economic warfare and the use of sanctions, and studying intelligence collections on foreign investment in the U.S. Was it good or bad, dangerous? Not from an economic point of view, but from a national security perspective. And I teach this at the U.S. Army War College. And the sanctions do work. They can be powerful against a country that meets 3 criteria. One, you don't have a lot of friends. You're a little bit isolated for other reasons. You don't have a large amount of reserves. You actually need the trade, and you basically don't have any workarounds. You don't have any alternatives to whatever it was that's being sanctioned. So, and kind of a medium-sized country. So Iran was a perfect target. They didn't have a lot of friends. It's a large country, but we're not talking about Russia, China, Brazil, and they didn't have a lot of reserves. So we put sanctions on them, going back to the Obama administration, 2010, 2011. They worked. I mean, we got the Iranians to the bargaining table. The fact that Obama did a lousy deal doesn't alter the fact that the Iranians came to the table. And then Trump very wisely tore up the deal and then tightened the sanctions. And we weren't, I had a debate with a treasury official once. I said, why did you keep going? We were on our way to regime change without firing a shot. Nobody wants, color revolution or boots on the ground, but we were kind of winning the financial war. And he said, well, we got them to the table and that was our goal. Fine. But Trump tightened them even more. And guess what? They weren't shooting missiles at Israel. The Houthis were not closing the Red Sea and the Suez Canal. Hezbollah was not on the warpath. None of those things were happening because we were putting the screws to Iran. And then when Biden took them off, the whole place is in flames. So there's a lesson there. But the point is, sanctions work against Iran. They don't work against Russia. They don't work against China. When you're that big and you have that many reserves and you have it in gold and you're exporting things where there's no price elasticity. You got to buy it: oil, natural gas, strategic metals, agricultural goods, wheat, etc. And you're the 12th largest economy in the world and the largest landmass in the world and the largest nuclear arsenal in the world and a decent sized population, you're strategically located from, the Pacific to the Baltic, you can't get pushed around. And the Treasury has found that out the hard way, because those sanctions, we put 13 rounds of sanctions on. Well, what are you going to do, 14? I mean, they don't work. Russian economy is booming. Russia is outperforming the United States, et cetera. And so, and I've been talking to some, Trump transition people, and they kind of get it. So the short answer is I would not expect sanctions of the kind we've seen to be applied against Russia and China, because simply because they don't work. It's not like we're nice guys. It's not in the U.S. interest. I would expect them to be applied to Iran, where they can work. So there is this nuance of, are you pushing around a little kid or a big kid? Well, they're two different results. Having said that, tariffs are not sanctions. Tariffs are an economic tool. They're as American as apple pie. It was only beginning in 1962 that the U.S. got into this whole free trade globalist, encasement mindset, which is the Austrians, von Hayek and Hayek and von Mises and others, run wild. But beginning with Alexander Hamilton, through John Quincy Adams, Abraham Lincoln, William McKinley, all the way up to Dwight Eisenhower, U.S. was a high tariff country, and look at the result. We had a strong military, a prosperous economy, and a lot of technological innovation, et cetera. So I expect a return to that. But again, tariffs are not economic warfare. They're economic policy. Sanctions, freezing, seizing, et cetera, that is economic warfare, but choose wisely when it comes to your opponent.